Welcome back to the deep dive. Today, we're taking on a topic that is just, absolutely critical for anyone in corporate finance or sophisticated trading.
That's right. We're getting into the nitty-gritty of how the world's biggest companies manage risk. We're looking at the core principles of derivatives, specifically hedging with futures.
And our mission for this deep dive is pretty focused. We want to move past the simple textbook examples.
Exactly. We're going deep into how professional traders and corporate treasurers handle risk when a perfect hedge just isn't possible. It's all about managing that imperfection.
Okay, so let's set the stage a little. We're talking about derivatives, and these are instruments that are, well, they're built for one thing, transferring risk.
But the key insight, and our source material really hammers this home, is that risk isn't something you can just make disappear. It doesn't
You
evaporate.
can't just delete it.
No, you can only move it around or transform it.
Yeah.
And when you transform it, you often end up with a new, sometimes surprising kind of risk.
And that's what we're here to talk about. That new form of risk, which has a name, basis risk.
That is the critical concept. You use a derivative to get predictable cash flow, which is great. But the moment you do that, you haven't eliminated risk. You've just redefined it.
So our goal today is to really isolate that redefined risk, quantify it, and understand how to manage it, especially when your hedge isn't a perfect one-for-one match.
That's the plan.
All right, so before we jump into the deep end with all the imperfections, let's just lay the groundwork. What is a hedge, fundamentally? What are the two basic moves a company can make?
Well, at its core, hedging is all about what you're trying to protect. You're either trying to lock in a future sale price or a future purchase price. That's it.
Okay, so let's start with the people who are selling things, the producers.
Right. So for them, you'd use what's called a short hedge. This is for any company that stands to lose money if the price of an asset goes down.
So think of a farmer with a crop in the ground, or an oil driller, a mining company.
Exactly. Anyone who produces something, they know they're going to sell that commodity in, say, 3 months. And if the price collapses between now and then, they lose a lot of revenue.
So to protect themselves from that drop, they take action now.
They do. They go into the futures market and they sell a futures contract. They take a short position. And that action effectively locks in the price they'll get for their sale in 3 months.
Let's make that concrete.
Yeah.
If I'm a natural gas producer, and I know I have a huge delivery coming up in February, if the price today is, say, $3, but I'm worried it'll be $2.50 by February.
Then you would short the appropriate number of February natural gas futures contracts today at that $3 price.
Okay. And then if the price does drop to $2.50, I lose 50 cents on my physical gas sale,
But your short futures position makes a profit.
Yeah.
You sold at 3 and you can buy it back at $2.50. So you make out 50 cents on the future, which cancels out the loss on the physical side.
you've neutralized the price risk
That's the goal. Now, the other side of that coin is the long hedge.
for the consumers. Exactly. This is for a company that's a consumer of a commodity. They're the ones who lose money if the price goes up. Think of an airline buying jet fuel or a manufacturer buying raw materials.
So if you know you have to buy something in the future, you go long a futures contract now. You're basically trying to lock in your maximum purchase price.
Precisely. You're protecting your input costs.
Let's use that classic industry example to really make this real. The copper fabricator.
It's a perfect illustration. So imagine a company that makes specialty copper wire. It's January. They've just signed a big fixed price contract to deliver all this wire in May.
So they know how much they're getting paid, but they don't know how much their main input copper is going to cost them.
Right. They know they'll need to buy, say, 100,000 pounds of raw copper around May 15th to fulfill the order. Now, back in January, the May copper futures price is, let's say, 320 cents per pound.
And their big risk, the thing that keeps the CFO up at night, is that copper prices could just surge between January and May. That could completely wipe out their profit on that wire contract. It's a massive exposure. So what do? They initiate a long hedge.
Okay, so the standard COMEX copper contract is for 25,000 pounds. They need 100,000 pounds, so they would go long 4 of those May contracts.
Yes, and their goal is just one thing: certainty. Fast forward to May 15th. They need to go buy their physical copper. Let's say the spot prices jumped, just as they feared, to 350 cents.
So they're paying 30 cents more per pound than they had hoped for the physical copper. That hurts.
It does, but Their long futures position has also gone up in value by about 30 cents. So the profit they make when they sell that futures contract perfectly offsets the extra cost of the physical purchase.
And their effective purchase price is locked in right around that 320 cents per pound they saw back in January.
That is the textbook ideal. It's clean, it's perfect, it's balanced.
And it's also, a bit too good to be true in the real world. This is where we have to start layering in the controversies and the operational problems that make hedging so complex.
Because we have to challenge the very idea that hedging is always the right thing to do. It's a tool, not a commandment.
Right. And the first big challenge you always hear, especially in academia, is the shareholder argument. The idea is if shareholders own a big diversified portfolio, why does the company need to hedge at all? Can't the shareholders just do it themselves?
This is a really powerful argument, and it's theoretically very sound. Why should a company spend all this time and money hedging, say, oil price risk, when a shareholder can just manage that themselves?
How would they do that?
By diversifying. They can own shares in an airline, which benefits from lower oil prices, to offset their shares in an oil company. Or, if they're sophisticated enough, they could even go into the futures market themselves and take an offsetting position.
I can see the logic there. As a shareholder, I might want that exposure to oil prices in my portfolio because I balanced it with something else, like tech stocks. If the company hedges, it's kind of messing with my personal risk management strategy.
That's the core of the argument. But corporate hedging is still a massive industry, and our source material gives two really devastating counterarguments for why that is.
Okay, what's the first one?
Information asymmetry.
Meaning the company knows more than the shareholder.
A lot more. Shareholders just don't have the same level of granular, real-time information that the company's own management team has. The Treasury Department knows exactly when and where the company is most exposed.
They're dealing with the day-to-day operational reality. A shareholder is just looking at quarterly reports.
Exactly. So management is just in a much better position to execute a really precise, effective hedge.
Okay, that makes sense. And the second counterpoint.
This was just pure pragmatism, transaction costs, and scale.
So it's cheaper for the big guys to do it.
Way cheaper.
Yeah.
I mean, think about a huge international company hedging hundreds of millions of dollars of exposure. They do it in enormous blocks, so their transaction costs per dollar are tiny.
Right.
Now imagine 10,000 individual shareholders all trying to do that same little hedge on their own. Their combined trading fees would be astronomical. It's just not efficient.
Right.
Hedging at the corporate level is simply cheaper.
So the efficiency argument usually wins. But, okay, let's say the board decides, yes, we're going to hedge. The complexities are just beginning. And a huge one is accounting implications.
Oh, this is the one that really causes headaches for CFOs. It's not just about being financially smart, it's about following the rules.
What rules are we talking about?
Well, accounting bodies have very strict rules, like ASC 815 in the U.S., about what actually qualifies as a hedge for reporting purposes. And how your derivative gets classified. Well, it has a huge impact on your financial statements.
What happens if it doesn't qualify as a proper hedge?
If it fails the test, maybe the correlation isn't strong enough or the paperwork isn't perfect, then the contract gets treated as a speculative position.
And what does that mean for the income statement?
It means the day-to-day mark-to-market gains and losses on that derivative hit your income statement immediately. It creates this massive artificial volatility in your reported earnings.
So even if the hedge is working perfectly to offset a physical risk, your quarterly earnings report looks like a roller coaster.
Exactly. And that can panic investors. They see a huge profit one quarter, a huge loss the next, and they think the company's unstable, even if the net result is zero.
I see. So the goal is to get it to qualify as a hedge. So the derivative's profit or loss is recognized in the exact same period as the gain or loss on the thing you're actually hedging.
Right. It smooths everything out and shows the true, stabilized economic picture.
Which brings us to a really counterintuitive point, one that I think shocks a lot of people. You can do everything right, execute a perfect hedge, and you can still end up with less profit than if you'd done nothing.
This is what we call the cost of certainty. And it requires a lot of discipline inside a company to accept this.
Let's go back to the oil producer. They used a short hedge to lock in a sale price of, say, $80 a barrel.
Right. And if the market price drops to $60, they're thrilled. The hedge saved them from a huge loss. They successfully protected their downside.
But what if the opposite happens? What if the price of oil skyrockets to $100 a barrel?
Well, they still only get their effective price of $80. They sell their physical oil for $100, which is great, but they lose $20 on their short futures position. The net result is still $80.
Meanwhile, if they hadn't hedged at all, they would have made a windfall profit of $100 a barrel.
Precisely. They gave up $20 a barrel of potential upside profit in exchange for eliminating the downside risk.
And this is such a critical point for anyone listening. Hedging is not a profit maximization strategy.
Not at all. It is a stability maximization strategy. A company has to be willing to forego those surprise windfalls in order to avoid those catastrophic losses.
It's a strategic trade-off. If your priority is a stable balance sheet, predictable cash flow to keep your lenders happy, you hedge, even if it means you miss out on a big market rally sometimes.
The cost of certainty is sacrificing that potential upside.
A deep distinction. You stabilize the price, but you have to accept that you might make less money than if you just got lucky.
That's the game.
Okay, now we can get to the real heart of this. Even if a company makes that trade-off, achieving that perfect stability is almost impossible. And that's because the futures price and the physical assets price, they just don't move in perfect lockstep. This is where we get basis risk.
Let's start with the key term itself. Basis. What is it?
In the simplest terms, what's the definition?
Basis, which we denote as $, is just the spot price of the asset minus the futures price of the contract at any given time.
So battle equals cent battle.
That's it. And this difference exists for all sorts of reasons: cost of carry, storage costs, interest rates, the time until the contract matures.
And the really crucial part is understanding how this little number, the basis, blows up the perfection of our hedge. Let's walk through the math on the effective price again.
Okay, so we initiate a short hedge at time 1 at a futures price of $50. We plan to live the hedge and sell our physical asset at time 2.
At time 2, the spot price is $2 and the futures price has moved to $2 and
So the total cash you receive is 2 parts. The money from your physical sale, which is $2, plus the profit from your futures trade, which is $5 F22.
Right, so the effective price you get is $2 plus F1 F22.
Now here's the clever part. We can use our definition of basis. We know that at time 2, the basis $2.2 equals $2 F222. So we can rearrange that to say $2.2 equals F2 plus B22.
And if we substitute that back into our effective price equation,
the 2W2 terms cancel each other out, and you're left with a beautifully simple result.
the effective price realized is just $5 plus B22.
Think about that. $5.1 is the futures price when you started the hedge. You know that number from day one. You thought that was the price you were locking in.
But it's not. The final price you get is that initial price, $50, plus whatever the basis happens to be on the day you close the hedge, B22.
And that's it. The entire uncertainty, the thing that makes the hedge imperfect, is wrapped up in that one unknown variable, the final basis 222 down.
And the uncertainty around that final basis is the definition of basis risk.
Exactly. If the basis strengthens unexpectedly, meaning it gets more positive or less negative, your effective price will be higher than you thought. If it weakens, your price will be lower. It's the risk that the spot and futures prices won't move together perfectly over the life of your hedge.
So a truly perfect hedge can only exist if, with certainty what the basis will be on the day you close out.
Which almost never happens. In theory, the basis should shrink to zero on the exact expiration day of the contract, but companies rarely hold hedges that long. They close them out early, or they're hedging something that isn't a perfect match to begin with.
Which leads us right to the two big causes of basis risk. These are the real-world problems that create this imperfection.
First one, and it's a big one, is asset mismatch. You'll also hear this called cross-hedging.
This is when the thing you're trying to hedge isn't exactly the same as the asset in the futures contract.
Let's use a great example. Jet fuel. Imagine a major airline. They know they need to buy millions of gallons of jet fuel for the busy winter travel season, which is 6 months away.
So they go to the futures market to lock in a price. But what do they find?
Well, they might find that there isn't a highly liquid, standardized jet fuel futures contract that goes out 6 months and can handle the massive volume they need.
So they're stuck. What do?
They have to cross-hedge. They use a different but closely related and very liquid contract. Often they'll use crude oil futures or heating oil futures.
Because crude oil is the main input for jet fuel, so the prices should move together.
They should, but they're not identical. The price difference between crude oil and jet fuel, that's called the refining margin or the crack spread, that can change dramatically.
So what could cause that to change?
Let's say there's a sudden unseasonable heat wave in the Northeast. Demand for heating oil just collapses. So the heating oil futures price plummets. But at the same time, the price of crude oil might stay steady because of global demand.
I see. So the basis between the physical jet fuel the airline needs and the heating oil future they're using to hedge it just blew out. It widened unexpectedly.
Exactly. When they close their hedge and go to buy their actual jet fuel, the effective price they pay is much higher than they thought they'd locked in. That asset mismatch created a ton of basis risk.
That gap in correlation is the vulnerability. Okay, what's the second major cause?
The second is maturity timing mismatch. This happens all the time.
This is when the date you need the physical asset doesn't line up perfectly with the futures contract's delivery date.
Let's go back to an oil refiner. It's June, and they know they're going to need a big shipment of crude oil sometime in late October or early November.
They look at the NYMEX contracts, which expire monthly. If they use a November contract, they're worried it might expire before they've actually bought the oil.
Right, that's risky. So they play it safe. They buy the December futures contract instead. They take a long position in 20 December contracts to hedge their purchase.
Okay, so they're hedged. Then, on November 10th, the tanker arrives, and they buy their physical crude on the spot market.
At that same moment, they have to close out their futures position, so they sell their 20 December contracts.
But here's the problem. The December contract still has more than a month until it expires.
Exactly. So on that day, November 10th, the difference between the November spot price and the December futures price will not be zero. They will still be different.
And the uncertainty is how different they'll be. Is the spot price 50 cents above the future or $1.50 above it?
That relationship, that spread, is uncertain. It depends on short-term supply and demand, storage levels, all sorts of things. That uncertainty about the spread on November 10th is the basis risk created by the timing mismatch.
This is such a critical realization. Basis risk is almost always a factor, which means that just doing a simple one-to-one hedge, well, it's often the wrong move. It can actually make things riskier.
It can. Which means we have to move beyond simple quantity matching and into the world of statistical optimization.
So if we know we have to cross-hedge, and we know the two assets don't move in a perfect dollar-for-dollar way, we can't just match the number of barrels or pounds. We need a smarter way to figure out the optimal number of futures contracts to use.
We need a way to minimize that basis risk we just talked about. And that brings us to the minimum variance hedge ratio, which is usually called a dollar.
Okay, before we dive into the formula, let's just get the intuition here. Why isn't 1-for-1 the right answer?
Well, think about volatility. Risk isn't just about the dollar value. It's about how much the price swings around. Let's say the asset I'm exposed to, maybe a very specific grade of coffee bean, is pretty stable. Its price doesn't move much.
Okay.
But the generic coffee futures contract I have to use to hedge it is incredibly volatile. Maybe it moves 5% for every 1% move in my specific beans.
So if you hedged 1-for-1, your hedge would be swinging all over the place, way more than your actual physical exposure. You'd actually be introducing more risk into your business.
You'd be overhedging. That's the core idea. The dollar ratio is designed to answer one question. How many dollars of the futures contract do I need to hold to perfectly offset the variance of my spot position? It's about balancing the risk, not the quantity.
So it's the ultimate tool for finding the calmest path in an imperfect hedging world. Let's look at the math that financial engineers came up with.
Okay, the formula for the minimum variance hedge ratio, nominal dollar, relates the volatility of the spot price to the volatility of the futures price. And it weights that by how closely the two prices move together.
The formula itself is actually pretty elegant. It's
The dollar's freak sigma.
right. But we need to make sure we understand every piece of that. Let's start with sigma s. That's the standard deviation of the change in the spot price.
So in simple terms, that's just a measure of how volatile my physical asset is, the thing I'm actually exposed to. A high sigma S means the price is all over the place.
Exactly. And similarly, sigma f is the standard deviation of the change in the futures price, F. That measures the volatility of the tool I'm using to hedge.
And then there's that Greek letter, rhos, or yes, 2 otters is the coefficient of correlation. This is the really crucial link. It measures how tightly the two price changes are related. A row of 1 means they move in perfect lockstep. A row of 0 means there's no relationship at all.
Okay, hang on a second. If this whole calculation depends on historical data, the sigmas and the rho are all calculated from past price movements, doesn't that create a huge potential problem?
Ah, you've put your finger on the massive, unavoidable vulnerability of this whole approach.
We're basically betting that the future is going to look like the past.
You are. The dollar ratio minimizes your risk assuming historical relationships hold. If something fundamental changes, a new technology, a war, a supply chain breakdown that affects the spot asset but not the futures contract, then that correlation can break down.
And your hedge falls apart. Basis risk explodes.
It does. So this isn't a magic bullet. It's the best statistical estimate of the optimal hedge, not a guarantee.
I see. So the ratio of the sigmas compares the two volatilities, and then rho kind of tells you how much you can trust that relationship.
That's a great way to put it. If the correlation rho is really weak, your dollars is going to be low. The model is telling you, hey, this futures contract is not a great hedge for your asset, so you should use less of it.
Okay, let's make this solid with a real computation. We'll use our own synthesized data set.
Let's move away from the usual examples. Imagine a specialty metals firm. They mine and sell a very specific high-purity grade of nickel. Let's call it grade Z nickel. That's their spot asset S.
Okay, but there's no futures contract for grade Z nickel.
Exactly. So they have to hedge using the big, liquid, but much more generic LME nickel futures contract. That's their futures asset F, a classic cross-hedge scenario.
They need to hedge their sales for the next 6 months, so they look back at the last couple of years of weekly price data to calculate their stats.
And their analysis turns up some really interesting numbers. They find a big difference in volatility. The standard deviation of the weekly spot price change for their grade Z nickel, sigma F, is $4.50 per ton. But the standard deviation for the LME futures, sigma F, is much higher, at $6 per ton. And the correlation between the two is pretty strong at 85.5 cents.
Okay, so what jumps out at me immediately is that the futures contract is way more volatile than the stuff they're actually selling. A 1-to-1 hedge would definitely be an overhead.
Absolutely. So let's calculate the correct ratio, $1.85 times frac 450.
Okay, so the ratio of the volatilities, $4.50 divided by 6 dero, is 0.75. Then we multiply that by the correlation, 0.85.
And that gives us 0 to 85 times 0.755, which is 0.63755.
So $, is about 0.64. What does that number actually tell the metals firm to do? It's an instruction, right?
It is. It's a very precise instruction. It tells them that for every $1 of grade Z nickel exposure they have, they should only short about 64 cents worth of the LME nickel futures contract.
Because the futures contract is so much more volatile, they need less of it to balance out the risk.
That's it exactly. Let's put it in terms of actual contracts. Suppose the firm needs to hedge 5,000 metric tons of its nickel, and the LME contract size is 6 metric tons.
Okay, so if they did a naive 1-to-1 hedge, they would just divide 5,000 by 6 and short about 833 contracts.
Right. But we know that's wrong. We need to adjust for value and for two. Let's say the current price for both is around $20,000 per ton. The total value of their exposure, VOA, is 5,000 tons times $20,000, so $100 million.
And the value of one futures contract, VOA, is 6 tons times $20,000, so $120,000.
So the formula for the optimal number of contracts, MIWEWE, is the total value of the asset times $6, all divided by the value of one futures contract.
So the numerator is $100 million times our dollars of 0.6375.
Which is $63.75 million. Now we divide that by the value of one contract, $120,000.
And that gives us approximately 531 contracts.
Look at that difference. The naive hedge was 833 contracts. The minimum variance hedge is only 531. By using statistics, the firm dramatically reduced the number of contracts it needed, which lowers their transaction costs and, more importantly, minimizes the variance of their final outcome.
That is just incredibly powerful. It's how real corporate treasuries think. They're constantly running these numbers to find that perfect risk balance.
And there's one more layer of sophistication we should mention, called tailing the hedge.
Okay, what's that?
Well, our calculation just now assumed the profit or loss on the futures is paid in one lump sum at the very end.
But that's not how it works. Futures are marked to market every single day. You get cash in your account or have to pay cash out daily.
Exactly. And because of the time value of money, those small daily cash flows are slightly different from one big payment at the end. In practice, professional traders will often make a tiny adjustment. They'll tail the hedge, usually reducing the number of contracts by a very small amount to account for this.
It's a fine-tuning adjustment that separates the academic theory from what happens on a real trading desk.
It is a small but important detail.
Okay, we have a great handle on how this works for commodities. Let's switch gears to financial assets. How do you use these ideas to hedge a large stock portfolio?
This is a massive area of use, especially for institutional asset managers. The principles are identical, but the way we measure risk is a little different.
Let's start with the simplest case. An asset manager has a fund that's designed to perfectly track the S&P 500.
In that case, we can assume the correlation is perfect and the volatility is identical. So the dollars is just 1.0.
And the number of contracts they need to short is simple. Total value of the portfolio divided by the value of one S&P 500 futures contract.
Right. But almost no actively managed portfolio perfectly mirrors an index.
Mhm.
Most managers have portfolios that are more or less volatile than the market. Maybe it's a tech-heavy fund, so it's much more sensitive to big market swings.
So in this world, we don't really use standard deviation. We swap it for a different measure of risk that comes from the capital asset pricing model. We use beta.
Beta is the industry standard for this. It measures a portfolio's systematic risk. That's the market risk you can't diversify away. A beta of 1.0 means your portfolio moves in line with the market. A beta of 2.0 means it's twice as volatile.
So for hedging stock portfolios, the optimal hedge ratio, $2 is it just becomes the beta of the portfolio.
That's the shortcut. We basically assume the correlation part, TURL, is close to 1, and the ratio of volatilities is captured by beta. So for beta hedge, yes, 1 age-old beta.
So you're not just hedging the dollar value of your portfolio anymore, you're hedging its risk magnitude, which is defined by its beta.
Let's walk through it. Imagine a fund manager with a $50 million growth fund. They run the numbers, and the portfolio has a beta of 1.3. It's 30% more volatile than the S&P 500.
So their true exposure to market risk isn't $50 million. It's effectively 50 million times 1.3.
It's $65 million of market equivalent risk. So they have to hedge that $65 million exposure, not the $50 million of assets. Their goal is to short enough futures contracts to drive the effective beta of their combined position down to 0.
Okay, to do that calculation, they first need to know the value of one S&P 500 futures contract, which can be a little tricky because of how they're structured.
Right, they use a multiplier system. It's not intuitive at first glance.
Let's look at a quick redesign table to see how it works for a couple of major indexes. Index focus, example, futures price, September 2026, multiplier per index point, $4 calculation.
DJIA, many $36,005. S&P 500, $5,500, $250.
Okay, so look at the S&P 500 contract. The price is quoted as $5,500. That's the index level, not the dollar value.
To get the dollar value of one contract, V8085, you have to multiply that index level by the contract's multiplier, which is $250.
So VDIO5 is $5,500 times $250, which is $1,375,000. A single contract controls over $1 million of market exposure.
So now our fund manager with the $50 million 1.3 beta portfolio can figure out how many contracts to short.
The formula for known dollars is the value of the portfolio times beta, all divided by the value of one futures contract.
So that's $50,000 times 1.33 divided by $1,375,000.
Right. So $65,000 divided by $1,375,000, that comes out to about 47.27 contracts.
You can't trade a fraction of a contract. So they'd have to short 47 contracts and just accept that the hedge is going to be slightly imperfect.
And that's the reality of it. You're using an imperfect number of contracts, 47, to neutralize a risk measure, beta, which is itself just a historical estimate. It's all about getting as close as you possibly can.
This brings us to a final and huge operational challenge, one that pretty much guarantees basis risk will be a factor in any long-term hedge. And that's the strategy of rolling the hedge forward.
This is a constant issue for any company with a really long-term exposure. Think about a gold mine that knows it will be producing gold for the next 3 years.
They can't just go out and short a single futures contract that expires in 3 years?
No, because the futures contracts that are that far out are usually not very liquid. There isn't enough trading volume. The spreads are wide. It's just not practical for a big hedge. The real liquidity is all in the nearby contracts, maybe the first 6 or 9 months.
So they have to use a series of short-term contracts to hedge a long-term risk.
That's the strategy. What they'll do is say, short the March contract to cover their first few months of production. Then, as the March contract gets close to expiring, they have to roll the hedge forward.
How do they do that?
They'll buy back their short March contract to close that position, and at the exact same time, they'll open a new short position in a contract with a later maturity, maybe the June contract.
And they just keep doing that. March rolls to June, June rolls to September, and so on, for 3 years.
For as long as they need the hedge. But what's critical to understand is how this transforms their risk, their original long-term price risk. What will the price of gold be in 3 years? Gets transformed into a series of short-term basis risks that they face every time they have to roll.
Okay, where does the basis risk come in during the roll?
The risk is in the price difference between the expiring contract and the new contract. It's called spread risk. The company is exposed to the risk that the spread between the March futures price and the June futures price will change unexpectedly right before they have to roll.
So if the June price suddenly spikes higher relative to the March price, right before their roll date.
Then it's going to cost them more to roll the hedge. They'll buy back their March contract at one price, but have to sell the new June contract at a relatively less favorable price. That little difference erodes some of the value of their hedge.
So they're constantly exposed to the risk that the futures curve itself will shift in an unpredictable way.
Precisely. Rolling the hedge forward is a necessary evil. It's a compromise. You swap a potentially catastrophic long-term price risk for a series of smaller, more manageable short-term basis risks.
It all comes back to that central idea. Risk is transformed, not eliminated. You get price stability from the futures market, but the price you pay is accepting this constant nagging basis risk that you have to monitor and quantify with tools like dollars.
That's the essence of modern risk management.
So to wrap all this up, the key insight is that while corporate hedging is vital for stability, it means giving up that potential upside profit.
And more importantly, when your physical world doesn't perfectly match the financial instrument, which is most of the time, you can't just guess. You have to use statistics like the minimum variance hedge ratio to minimize that unavoidable basis risk.
It's all about moving from a theoretical, perfect world to the practical, messy reality of markets.
A very disciplined process. And before anyone, you or your company, puts on a big hedge, you really need a clear-eyed strategy.
Absolutely. So let's end with an investor decision checklist, some key questions drawn from everything we've discussed to guide your thinking.
First, exposure analysis. Simple but critical. Do I need a short hedge, meaning I lose if the price falls? Or do I need a long hedge, meaning I lose if the price rises? You have to get this right from the start.
Second, basis risk assessment. Is the asset I'm hedging identical to the one in the futures contract? Is my timing a perfect match? If the answer to either of those is no, then I can't just do a one-for-one hedge. I have to calculate a null or a beta to make sure I'm hedging the right amount of risk.
Third, hedge effectiveness and corporate discipline. This is a big one. Am I truly prepared to make less money than I could have if the market moves in my favor? Have I accepted that opportunity cost, and has that been communicated clearly across the entire company?
Fourth, strategic alignment and accounting. Does this hedge actually serve our bigger goal of predictable cash flow? And have we done all the paperwork to make sure this qualifies as a true hedge for accounting purposes so we don't create a nightmare on our P&L statement?
And finally, fifth, liquidity plan and roll strategy. If I need a long-term hedge, do I have a clear, documented plan for how I'm going to roll it forward? And have I thought about and quantified the spread risk I'm going to face at every single one of those rollover dates?
So when you boil all this financial engineering down to one core idea, we spend so much time in finance talking about maximizing returns.
We do, but in corporate finance, minimizing variance is often much, much more important. Predictability is the bedrock of a strong business.
So if a company can reliably forecast its costs and its revenues, even if it means missing out on a windfall now and then,
it gains a huge strategic advantage. It can budget better, it can plan capital expenditures, it gets better terms from its lenders. It's more stable than a competitor who's just swinging for the fences and risking a catastrophic loss.
the minimum variance hedge ratio, basis risk, it's all just mathematical proof that the most successful strategies are often about prioritizing stability over speculation. It's about defining and accepting the cost of certainty.
A fantastic journey through a really complex but essential topic. Thanks for guiding the conversation.
My pleasure. We'll see you next time on The Deep Dive.